Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. December 13th was the last FOMC meeting of 2023, so we figured no better time than the present to share our thoughts on the economic outlook for 2024. Today's webinar is not going to be your traditional dry, statistics-filled economic discussion. Instead, we're going to take a walk back through 50 years worth of news headlines to see what history fails to teach investors each time we go through an economic cycle. Next, we're going to turn to the Pacific Point Research Lab's deep historical charting capabilities to illustrate the current economic environment within the context of 30 and 75-year trends to explore three potential trajectories for the economy heading into 2024. Let's go ahead and get started. You've all seen the headlines. You've all seen it in the Wall Street Journal and seen it on CNBC, this ongoing debate as to whether we're going to have a recession, whether we're not going to have a recession, and ultimately what's going to happen. Here's a headline from the Washington Examiner on December 4th. Aggressive rate cuts are being priced in, and economists believe that we can avoid a recession. Again, you've seen this, and you've seen all the back and forth, right? So here is a Bloomberg story on the 8th of December, and this was released just prior to the November jobs report coming out that Friday morning. And Bloomberg Economics was reporting at the time that the recession probably began in October. Right after the jobs report, that same day, CNBC runs the headline, the soft landing has arrived. In the latest FOMC press conference, Jerome Powell mentioned that it's still too early to declare victory, that inflation is too high, that ongoing progress in bringing it down is not assured, and that a recession is still a real possibility in 2024. While Fed policymakers did not take another rate hike off the table, it is no longer their base case, and now the timing of rate cuts is really the next question. If it feels like most investors, economists, and academics have been waiting for well over a year for the recession to arrive, it's because most have. So why are recessions so hard to predict? In the spirit of the 2023 AI rally, I decided to ask Bing why future recessions are so hard to predict. The response is, economists cannot predict the timing of the next recession because forecasting business cycles is hard. And then goes on to illustrate how wrong economists have been in the past with their forecasting. Moving on to Bing AI Chat, you get the same answer with an explanation backed by an article written by the Philadelphia Fed. We're not going to get into the details of the Philly Fed article, but I invite you to try the searches on your own. The results are very interesting. Knowing how hard it is to predict business cycles and recessions, let's roll the tape back 50 years and have a little fun and look at a few news headlines to see what history fails to teach investors every time we go through an economic cycle. Starting with a headline from September 3rd, 1973, the New York Times article about a soft landing. The mid-1970s turned out to be anything but a soft landing, with soaring unemployment and an oil crisis taking a toll on the economy. The recession of 1973 to 1975 saw a 3.2% decline in GDP and unemployment peak at 9%. Here's an article in the September 15, 1978 Desert Sun newspaper. Headline, Soft Landing, Economy Seen. Leading up to the 1980 downturn, there were plenty of respected economists predicting that a soft landing was imminent. During the recession of 1980, GDP declined 2.2% and unemployment peaked at 7.8%. Here's an article in the January 17, 1980 edition of the News Journal newspaper. Headline, Economy Should Take Medicine in 1980. In 1980, there were plenty of predictions that the economy would remain resilient enough for a soft landing. The recession started in the middle of 1981. It was even worse than 1980, with GDP declining 2.8% and unemployment peaking at 10.8%. Here's another article from the May 22nd, 1989 edition of the Portage Daily Register. Headline: U.S. economy seems headed for a soft landing. In May of 1989, the Associated Press ran a story about how the economy was headed for a soft landing. The U.S. economy went into recession in 1990, and unemployment peaked in 1992 at 7.8%. Nearest and dearest to most watching this webinar was in 2007, when there were plenty of predictions that Federal Reserve Chairman Ben Bernanke was going to guide the economy into a soft landing, even with the implosion of housing in the US. The Billings Gazette article from January 2007 starts out stating that since becoming the chairman of the Federal Reserve last February 1st, Ben Bernanke has steered the US economy to an apparent soft landing amid a housing recession. We all know how the Great Recession turned out. The US economy saw unemployment hit a peak of 10% in 2009, and GDP slipped by 5.1%. We can now utilize big data technology and search the number of news articles mentioning soft landings versus recessions. The following 38-year bar chart is captioned "Soft Landing Hopes and Hard Landing Realities." The chart is sourced from Bloomberg and illustrates that soft landing optimism tends to peak before recessions and subsequent downturns hit. We can also narrow our focus on year-to-date mentions of hard versus soft landings. In this case, we will use the Pacific Point Research Lab historical document search capability. The following top area chart depicts heightened concerns of a hard landing that reached their peak amid the regional banking crisis in the March-April timeframe of the current year. Subsequently, the bottom panel chart illustrates a shift towards renewed optimism for a soft landing. Looking at the area chart on the following slide, you will note that there remains a third possible trajectory, one that does not grab the attention of the media and the headlines, but is consistently mentioned in research publications, press releases, conference call transcripts, and investor slide decks. And that is the inherent stagflation risk associated with an extended no landing scenario. In the following set of 30-year charts, you're going to see exactly why this cycle is so different when compared to previous cycles. In the top panel, the manufacturing sector of the US economy, the blue line, has been in contraction now for over a year. Consumer spending continues to drive the services sector, the green line, into expansion territory. But it is nearing the contraction breakpoint of 50 as measured by the Institute for Supply Management. You will want to note that periods of time when the services sector follows the manufacturing sector into contraction have marked the start of previous recessions, and you can see recession bands shaded in gray in both charts above, and you can see those trends here, here, and here. In the bottom panel, the 1-year percent change in the core PCE inflation is plotted in red, and the US federal funds rate is plotted in blue. The horizontal red line marks the Fed's 2% target rate for core PCE inflation. I always say that a picture is worth 1,000 words. Have a look at where we are currently relative to prior cycles and ask yourself, how far off is the Fed from really attaining their 2% inflation target? Everyone is going to have a different opinion about this, including individual Fed board members. Please keep this chart in mind the next time you hear noted academics and economists urging the Fed to declare victory against the war on inflation. It should be obvious from the bottom panel chart above that it is likely a bit premature to declare victory at this point when compared to Fed action relative to the levels of inflation in prior cycles. Remember, even as of this latest FOMC meeting of 2023, Powell mentioned that it is too early to declare victory, that inflation is still too high, and ongoing progress in bringing inflation down is not assured. In the following slide, we're going to look at another set of factors complicating the job for the Fed, and that is the 30-year history of the Conference Board of Leading Economic Indicators plotted in green versus the one-year change in real GDP plotted in blue. The red horizontal line marks the 0 point or the break point for contraction. You will note that in normal economic cycles, the one-year percent change in GDP tends to follow the leading economic indicators into contraction. You can see from the current level of change in GDP versus the leading economic indicators that we have not seen this level of disparity in any of the 3 previous economic cycles. As a matter of fact, you can see that the leading economic indicators have been in contraction for well over a year, while the GDP is just now hitting a cyclical peak. We will want to keep our eyes on GDP growth over the coming quarters to see how the long and variable lag effects of Fed policy hits the economic growth relative to the leading economic indicators. Over the following 2 slides, we'll examine how the Federal Reserve is gradually succeeding in its efforts to moderate the job market. In this particular 30-year chart, the investment committee at Pacific Point prefers to plot the one-year percent change in CPI all items in blue and use this as a reference line so that we can observe how both sides of the Fed's dual mandate are now coming into balance. The maroon line is the one-year percent change in labor productivity, and the green line is the one-year percent change in average hourly earnings. Please be aware that labor productivity has surpassed the average pre-COVID level, which carries 2 positive implications. Firstly, corporate profit margins grow as the existing workforce produces more output. Secondly, heightened labor productivity leads to a reduced demand for workers in the job market, thereby moderating average hourly earnings. You will want to note the steady decline in average hourly earnings noted by the green line. The Fed is gradually succeeding in its efforts to moderate the job market. However, the current rate of wage growth remains elevated above prior cycles and is not consistent with the Fed's 2% inflation target. In addition to the increase in labor productivity helping to ease wage pressures, the recent bout of inflation has brought workers off the sidelines and back into the labor market, increasing the supply of labor. The following 75-year chart illustrates that the labor force participation rate has reverted to levels consistent with the pre-COVID era. The reference line in red is drawn at 62.4% and represents the pre-COVID era low point of labor force participation reached in November of 2015. While this is certainly helpful for the Fed's effort to moderate the job market, a soft landing cannot be achieved unless the Fed can successfully restore its dual mandate without triggering a recession. Anticipating 2024, it's vital to assess the limits to which a labor market breakdown can reliably forecast an imminent recession. At Pacific Point, we utilize mathematical transformations on the headline unemployment rate to strengthen its statistical explanatory powers. The following chart shows the year-over-year difference in the U3 unemployment rate and illustrates that a 1% year-over-year increase in unemployment has preceded each of the last 12 recessions going back to 1949 with no false positives. You will note that we have now entered the inflection zone. This is the range between 0% and 1% as evidenced by the black horizontal reference lines. As we move through 2024, our attention will remain focused on monitoring the year-over-year variance in the U3 unemployment rate, to further narrow the path of potential trajectories for the economy in 2024. For those of you who subscribe to our research lab, you may recall the year-over-year difference in the U3 unemployment rate looking very different back in January of this year in the webinar titled "Equity Investors Aren't the Only Ones Fighting the Fed." If you have not seen the January 25th webinar, I would encourage you to watch it. It's only 11 minutes long. And while you're there, be sure to subscribe to our research. You can access the webinar from our research lab on our website at www.pacificpoint.net. That brings us to three potential trajectories for the economy in 2024. Trajectory one, the soft landing. This is when the Fed restores its dual mandate without triggering a recession. Gradual, or what others have termed immaculate disinflation, back down to a 2% long-term trend rate. Unemployment remains within the bounds of maximum sustainable employment. The Fed gradually lowers rates commensurate with inflation to effectively land the economy. Trajectory number two would be the hard landing scenario. This is where we have an economic downturn after the recent period of growth. This is where the long and variable lags of Fed action bring about more rapid disinflation. Unemployment subsequently rises outside the bounds of maximum sustainable employment. The Fed begins rapidly lowering rates to revive economic activity. And trajectory number three would be the no landing scenario. This is where we have economic growth despite the Fed's best efforts to tamp down inflation with interest rate hikes. Inflation ends up getting stuck above the 2% Fed target rate for an extended period of time. Fed maintains a higher for longer rate policy stance, causing a drag on economic growth. And the longer term risk of stagflation if inflation reverses course and moves higher. As this happens, the risk of a hard landing increases. To get an understanding of what the S&P 500 might look like next year, we can go back to a previous slide and replace the PCE core inflation line with the price of the S&P 500 in pink, plotted on a log dual scale alongside the US Fed funds target rate. So you're going to read the S&P 500 scale in log over here on the left side, and you're going to look at the US Fed funds target rate in blue in a linear scale over on the right. I left the top panel on the chart because next year, you're going to want to pay close attention to the ISM services numbers. The closer we get to 50 or even breach 50, the more likely we are to experience a hard landing. Let's look at the soft landing scenario that took place in 1994 to 1995. Many economists say this period of time was a textbook soft landing. You can see that the S&P 500 continued to rally as the Fed successfully restored its dual mandate without tipping the economy into a recession. This triggered a bull market rally that ended with the year 2000 dot-com bust. The hard landing scenarios are readily visible by looking at the recession time periods shaded in gray. In these cases, the S&P 500 contracts alongside aggressive cuts in the US federal funds target rate. Navigating the no landing scenario poses a challenge as the plane inevitably requires landing. It is important to note that an extended no landing situation elevates the risk of stagflation and a potential recession. Considering what we've been through since COVID, I'm sure that 2024 promises its fair share of surprises. If you are a financial advisor or an individual investor and would like more information on how you can work with Pacific Point Advisors, please contact us at 858-356-6600 or email us at info@pacificpoint.net. Be sure to visit the Pacific Point Research Lab on our website. And while you're there, remember to sign up to receive our research delivered directly into your email inbox. You can also connect with us on LinkedIn at Pacific Point Advisors LLC. Thank you all for attending, and we'll talk to you next time.